Bitcoin's been outperforming the S&P and gold and NASDAQ for quite a while. If you don't need your money for 4 years, I would say buy Bitcoin and hold it forever. But if you need the money in the next 4 months to pay your kids' tuition, or if you need working capital or to pay taxes, you can't afford to take that risk. You're gonna want a credit instrument. So STRC is like short-term money, BTC is long-term commodity, and then if you're an equity investor and you want amplification, you would buy the common stock. I want to talk about digital credit. Digital credit is based on digital capital, and so we wanted to create the best credit in the world. How do you create the best credit, the highest yielding credit? Well, you need the best performing asset. So you see Bitcoin's been outperforming the S&P and gold and NASDAQ for quite a while. And we started thinking, can we carve a credit instrument out of Bitcoin? Now it turns out the volatility of all these assets is quite high. And so the impediment to spreading Bitcoin to the world is 40 vol is too much for most investors. And without the cash flows and with the vol, it's a difficult sell. Believe me, I know. I've spent thousands and thousands of hours doing this. So what's the idea of digital credit? The idea is you use a capital gain to fund a credit dividend. We strip a certain amount of yield out of the capital gain. And so if you think you're getting 30%, you can extract 11. If you think you're getting 6% from real estate, you can pay a dividend of 3. And so as you can see, Bitcoin's the highest performing capital, and so we can pay the highest dividend. What else do you need to create asset-backed credit? Well, you need a lot of assets. And so you need a lot of equity capital. And the thing about Strategy, my company, is we've got about $68 billion worth of capital, and we've got an $85 billion enterprise. So when you have a tower of equity, the question becomes, how are you going to get yield on it? What are you going to do with all that capital? And what we realize is the killer app for Bitcoin is digital credit. That is, we don't borrow against it in a conventional way. We sell the credit into the TradFi, the traditional capital market, and we offer a yield. And for every dollar of capital, you can probably sell 20 cents of credit a year. So you want to create $20 billion of credit, you want to start with a $80 or $100 billion of capital. The big advantage we had is we had a big equity capital market. We have $3 billion in trading in the equity market. We have a massive derivative market. Some people don't know, but MSTR trades more than IBIT. Our open interest is more than IBIT's open interest. So we've got the equity capital traders and the derivative traders supporting this security, and then we wanted to use this to create credit. What's credit? Well, we take a block of capital, we strip the currency risk, we strip the credit risk, we strip the duration risk, we damp the volatility, and then we distill a yield. So think of it as taking a barrel of crude oil, putting it through a reactor, and coming out with kerosene, right? Digital credit is like monetary fuel. If you have a volatile capital asset, it's a 30 or 40 vol, you've got this, crazy roller coaster. What we're doing is we're extracting that first 11%. And most people, they want to compound their wealth comfortably. They don't want to risk their principal. They just kind of want to compound their wealth progressively without a massive drawdown. So what happens if you actually process that signal and you create 11%? Well, you have excess energy, excess volatility. Where does it go? It goes to the equity. And so the very act of creating the credit actually creates a digital equity that is actually more volatile and higher performance than the capital asset. Hence, MSTR is amplified Bitcoin. STRC is Bitcoin credit. Does it work? I show you the theory. This is the actual result. This is 5.75 years of data. You can see since August of 2020, Bitcoin's up 40%, MSTR is up 60%. Notice where STRC is. That's your credit. So what we're doing is we're straddling both sides of a capital asset. There's a set of people that want leverage and performance in the roller coaster, like strap on the rocket, pull the G's. And there's another set of people that just want to live happily ever after, comfortably, and they'll give up the excess performance, and we're giving them both. So what is it? Well, we're really just combining things that have been around. A listed public stock, a listed digital capital, Bitcoin that you can trade, a listed preferred stock, a variable monthly dividend on a preferred, a return of capital treatment, it's a 100-year-old tax code, and an actively managed ETF. If you put them all together in one instrument, you can create digital credit. What is it? It's double-digit returns, tax deferral. It's all the benefits of equity. It's low volatility and capital preservation, all the benefits of credit, all in one instrument. If you don't need your money for 4 years, I would say buy Bitcoin and hold it forever. But if you need the money in the next 4 months to pay your kids' tuition, or if you need working capital or to pay taxes, you can't afford to take that risk. You're gonna want a credit instrument. So STRC is like short-term money, BTC is long-term commodity, and then if you're an equity investor and you want amplification, you would buy the common stock. What's unique here, we discovered, is that if you actually use unrealized capital gains to pay a credit dividend, the dividend becomes tax deferred. That's called return of capital. We inadvertently created the most efficient, scalable generator of tax deferred fixed income in the world. We weren't trying, we just tripped over this. How's it working? Stretch has got $375 million of liquidity a day. We got the vol from 40 down to 3. It has grown to $8.5 billion of AUM. It's growing at 340% a year. It's hyper growth. It's the most successful financial instrument of the year. Why is it growing? And how is it growing? Well, it's growing because it's powered by the crypto economy and by the volatility of 24/7, 365 digital assets. It's now the biggest preferred stock in the world in 8 months. It's also the most liquid preferred stock in the world in a few months. It's also the highest turnover preferred stock in the world. So we created something which turbocharged the entire economy of preferreds. In the last 6 months, Bitcoin traded down 37%. If you're a capital investor, you get no yield and you take the 37% hit. If you're a credit investor, you got 6.4% in dividends and you held par. So if you're wondering why would you want to own it, well, that chart illustrates exactly why you would want to own it. Stretch is new. You can see it's seasoning, and in the last 3 months, it's been in the trading range 100% of the time. So it's really just the past 3 months that this thing is clicking and coming to life. The liquidity has grown 7x in 5 months, and it keeps building. Why? Well, because a money market pays you 3.5%, private credit pays you 8.5%, Stretch pays you 11.5%. If you're a retail investor, if you pay taxes in the US, that's a tax equivalent yield of 18% in Miami. How does it compare to the rest of the world? Well, Stretch is like the risk-free rate in the crypto economy. If you're looking for the free market risk-free rate, it's 11.5%, and it compares to, nothing in yen or Swiss francs. But now if you look at this chart, you see there's a mother of all arbitrage opportunities here. If you're looking for the carry trade, you borrow at 2% in euros and you invest in Stretch, you catch the difference. If you're a DeFi trader, imagine looping 2% to 11.5%, capturing 9.5% times 10. Now 10x leverage sounds dangerous on a 40 vol asset, but what if I give you a 2 vol asset? At 2 vol, you can 10x lever it, and the volatility is like the S&P index, but you captured 95% yield. Okay, so this is very interesting what's going on here. If you live in New York City, Stretch is like a bank that pays you 24%. Why wouldn't you want that, right? I mean, same in San Francisco. Now, if we look at risk-adjusted rates, the Sharpe ratio is you take the yield, you subtract the risk-free rate, you divide by the volatility. What you can see is Stretch has got the highest Sharpe ratio of any credit instrument in the world by an order of magnitude. Money markets have a negative Sharpe ratio. Stretch has got a higher Sharpe ratio than any equity you can buy. It's, actually this is an asset than any asset you can buy, like the S&P or Bitcoin. Stretch outperforms NVIDIA, right? And finally, if you go to a hedge fund and you paid them 2 and 20, Stretch outperforms every hedge fund strategy publicly disclosed by every hedge fund. And so, how is this interesting? It's interesting because the hedge funds lock up your money, charge you a fee, take a carry, and take heterogeneous risk. Stretch is liquid, no fee, zero fee. You can get in and get out whenever you want. It's homogeneous. It's transparent. We update the risk every 15 seconds. So digital credit is really attacking the credit markets, and there's no reason why it won't transform 1%, 2%, 10% of a $300 trillion credit market, because everything else compared to Stretch is like return-free risk. Now, how does it impact the ecosystem? There's an explosion of interest. There's retail interest, there's corporate interest, there's institutional investors buying it, there's crypto native firms building on it, and there's TradFi innovators building on it. So first of all, Stretch is distributed through all retail brokers. It trades on NASDAQ. You can buy it on Schwab, Robinhood. Vanguard doesn't let you buy Bitcoin, but they let you buy Stretch. And so we've used it to get to every traditional, conventional investor. 80% of Stretch out of the gate is retail, massive retail following. Just like crypto is retail, Stretch is retail. It's going viral. Everybody tells their friends, their family, their parents. Because why wouldn't you? I mean, who doesn't want to retire and get paid 11% and not get taxed on it? Like, why wouldn't you want to do that? Corporations are using it as part of their corporate treasury. Instead of 3% taxable or 2% after tax, it's 11% tax deferred. It's number 2 in the credit indexes of BlackRock and Van Eck in the first 8 months. So it's really crawling up, and it's embedded in all of these other fixed income funds. There are a lot of ETF developers that are building on top of it, so you're going to see it in public funds. Compelling thing about digital credit is it is the stepping stone to digital money and digital yield, and that's where everybody in this room ought to be interested, because this is your business. What we've done is taken digital capital, which is too volatile with no yield. We've converted it into a 3-vol, 11% yielding credit instrument by stabilizing it with billions of dollars, actually $60 billion worth of equity capital. And now the opportunity is at layer 3 to create digital money or digital yield. And what do I mean by that? I mean, money is zero volatility, daily liquidity instruments with yield. Digital yield is maybe non-zero volatility or maybe a liquid staked yield. So how do you create this? You can create a token, a private fund, a public fund. You can offer it on a bank. You can offer it on a crypto exchange. You can program the volatility from 0 to 10. You can program the yield from 5 to 25 or even more. You can program the liquidity, and you can transform the currency. Lots of people might do it. You could do it as a bank, a Wall Street operator, or maybe most interesting, a crypto entrepreneur or a startup or any innovator. If we give you 3-vol, 11% credit, you can step it down to 0-vol, 5% money, or 6 or 8 or 9. Or you can step it up, lever it 3 or 4 times, and make it a 25% instrument. If you want it liquid every day, it'd probably be 25% instrument with 8-vol. But if you want to make it a lockup for a month, it might very well be 0-vol, 1 month liquidity, 25% yield. Who needs it? the stablecoin market, right? It's $350 billion. It's all starved for yield. How are you going to actually put yield on this? There's crypto native yield. It's endogenous. When activity explodes, it expands, and when activity contracts, it contracts. There's also exogenous yield, and here digital credit competes with treasuries. The challenge with endogenous yields is they're reflective. So in a bull market, you'll get good yields, but in a bear market, the yields compress. On the other hand, the benefit of treasuries is it's external, but the problem is if your cost of capital is 3% and then the asset pays 3%, then their net yield is 0. And then so if you lever up 10 to 1 on 0, it's 10 times 0, it's just 0, right? There's nothing there. What you want to do is start with 3.5% money and then lever on 11.5% yield. Now you get a net 800 basis points, lever that 5 to 1, and you can actually create a 40% yielding instrument.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.